Chairman and Chief Economist with Hugh Johnson Economics, joins us now. Mr. Johnson, good morning. Thank you for joining us. Well, you have a deal in place with some countries, you don't have a deal yet, and for some countries like India, looks like the deal is still in the works. How should markets look at 9th of July deadline in terms of the tariff playbook?
What you really have to do is you have to learn your lessons from history. And in this case, learn your lessons. All of us should learn our lessons from the so-called Trump 1 2018, 2019 tariffs and trade wars. And one of the distinct characteristics of that trade war, which you're now seeing in the last couple of hours, is that these are on again, off again negotiations, and they're extraordinarily volatile, and they lead to an extraordinary high level of uncertainty among business people. That's what happened in 2018 and 19. It's happening again now. It's leading to uncertainty, and that uncertainty alone, let alone the economic impact of the tariffs, the uncertainty alone is creating problems for obviously business leaders and therefore the stock market. So I think that's the first thing. Learn the lessons of 2018 and 19, and you'll have a good idea of what to expect in the next, say, 2 to 4 weeks.
Hugh, from an equity market standpoint, though, do you think the ramifications and repercussions are well in the price because it's been such a long drawn process and now the deadline only gets shifted to August?
Yeah, as far as the tariffs go, again, having postponements till, we've seen that already a couple of times. We certainly saw that in 2018 and 19. I don't really worry about that. Keep in mind one other thing, which is very important, is Trump is turning up the pressure on tariffs, trying to increase tariffs, and also increasing the pressure on countries to increase the tariffs that they pay us. But keep in mind, the most important thing, he's just passed, or we've just passed, the U.S. has passed that big, beautiful budget act. And that's going to be a $3.4 trillion deficit over 10 years. And somebody's got to come up with the money. One of the ways to come up with the money, and you see that in just about everything we hear from this administration, is through the revenues that are generated from tariffs. Now, I've looked very hard at those revenues that we're getting from tariffs for the last 3 months when we've had tariffs. And quite frankly, although there's fairly substantial revenues that the U.S. will get from tariffs, and maybe even higher revenues after he gets through with this current round, but it's not going to be anywhere sufficient to try to offset the lost revenues as a result of a $3.4 trillion deficit over 10 years as a result of this so-called one big, beautiful budget bill. So we've got to find those revenues in order to pay off that deficit. The other place, of course, is we'll borrow the money. The U.S. will borrow the money from foreign governments, and foreign private and public investors have shown some reluctance to step up to the plate to buy U.S. treasuries. So maybe that'll require higher interest rates. I don't know, but there's no question that a substantial part of the $3.4 trillion won't come from tariffs, but it will come. It will have to be borrowed, and borrowed again in part from foreign countries, private and public investors.
That is a concern, and if debt is only going to go higher because tax cuts and tariff will have an impact on the economy, why are U.S. equity markets at a record high? Shouldn't they be moving the other way?
I'm sorry, well, I didn't quite get that question.
No, my question is that if tariff impact would be there on the economy, if tax cut impact would be there in terms of how the yields would move and what will happen to the U.S. Government's revenue, then equity markets, at least U.S. equity markets, they should be nervous.
Well, I'm not sure what you're saying, but if the question has to do with the revenues that are generated as a result of declining taxes, and certainly taxes decline, we will start to see some offset to the lost revenues as a result of the tax reductions. But the tax reductions will also lead to increased economic activity. The Congressional Budget Office calls it the dynamics of budgets. So we're going to see some offsets, some trade-offs there, some improvement because of increased economic activity. I think that's what you're getting at. And if that is what you're getting at, both the Congressional Budget Office and myself will agree that we'll get some revenues, and those revenues will offset that $3.4 trillion deficit, but not enough to really make a difference. Again, it's going to be funds coming in from collections on tariffs, and the second thing, borrowing the money in the credit markets from both domestic U.S. investors and foreign or private and public and private foreign investors. That's where the money's going to come from.
You're so good having your insight today. Thanks for your time.
You're welcome. Nice to be with you.